What's up, guys? Welcome back to the channel. I know it's been a while. This is Cruz. I'm the head trader and founder of NewAgeWallStreet.com. I am most known from going from homeless to seven figures in 18 months, thanks to an awesome bull market and monster Tesla moves. But yeah, homeless to seven figures in 18 months. We trade primarily options, stocks, and the New Age Wall Street Room. It's absolutely free. There's a link in the description if you do want to sign up. We'd be happy to have you and teach you a little bit more. But in this video, we're going to go ahead and talk about a little bit of how open interest in the options market, the derivative market, is actually dictating the way that intraday moves are happening. So, especially with the SPY having everyday expiration now, it's kind of showing a little bit more now that we're getting a little bit more data and everyone's kind of getting a little bit more used to it. And it's no surprise that uh, the zero DTE option flow, so the same day options that are being traded, are the biggest that they've ever been traded in history. So let's go ahead and take a look. I thought today would be a really good day to go ahead and do this. We're going to go ahead and look at the SPY today. And since kind of the title of this video, right? This is the best way to go ahead and trade SPY, in my opinion. Whenever, and now we have the power of hindsight. The market is closed. You guys can see what time it is. But whenever I start off my day, what I do, one of the first things I do is I come over and I look at the option chain, right? And if you take a look at where we started our day right here, we started off around 390 ish or so, right? So if we come and we look at where we started the day for the where the open interest and where the options are positioned, you can see right here that at the 390 there was some big open interest right here between the 389 and 390. There's 15,000 contracts right here, and there's 16,000 contracts right here, right? On the other side, there is not that much, right? So at the same prices, you can see that it starts getting thicker and bigger here around the 387. Now, it used to be, and you guys have all probably seen, if you're watching this video, you probably, if you haven't, go check out that video of flow algo, right? Everyone kind of knows cheddar flow, flow algo, unusual whales kind of gives that option flow where you could see big positions coming through that are being swept or blocked through the market at any given point, right? And I traded like that a long time too, where once I saw some really aggressive calls or sweeps, or excuse me, sweeps or blocks coming through, I would follow along with them and go along with those trades in that direction. Now, the thing is it's a little bit counterintuitive because we got to start thinking of these as kind of transactions instead of just directional trades, right? So for every buyer, there has to be a seller as well, right? And we could assume that on the option flow that we're seeing, a lot of it is retail trading, and even though it is bigger size, there's dealers that have to sell that premium in order for the transaction to take place, right? So, for instance, right here, if you're selling these 390 calls right here, your goal is to keep the price underneath here until they expire, right? So your goal is to make the 390s expire worthless, the price stay underneath here, and you're collecting the premium, right? If you were to buy these 390 calls, your goal is for the price to be above this here at any point above the before the expiration date in order for you to make money, right? Now, you got to kind of think of it like this, where the dealers that are doing this have a whole lot more money than what retail traders, you and I, have, and they're able to manipulate the stock to be able to get what they need to done, right? And so in this instance, they will do what they need to do, which includes selling the stock or even futures in order to get the price back underneath this 390, right? So if we're making our game plan in the morning, we know that this is going to be resistance because the dealers want to keep the price underneath this, right? And then we look a little bit further up. If this does go ahead and break, we see that this 392 right here is 12,500 contracts, right? So another resistance if we were to go further up, and then it gets a little bit bigger here at the 395, right? So if we come and we look at the price action and what we have here today, what we had here today, I should say. I'm going to switch over here to the 5 minute time frame. We opened up around this 390 area. We dipped, right, which is absolutely fine. We dipped here to this demand area, and then we went up, and so we broke a couple of those. We didn't break to the downside of that 390, right? So we reclaimed the 390, and then we pushed up, and we even broke 392, where that big high open interest was, and we got up to 393.50 or so, right? Now, I know a lot of you were probably thinking like maybe we get to 395, we're trying to push a little bit further. You start getting some FOMO in the tank, and you think that it's going to keep on going all day. Well, this is a really good setup whenever you get a really big move here in the morning of knowing what the market makers and the dealers need to do by the end of the day, right? So if your goal is as a dealer is to finish underneath this 390 and underneath this 392, and we're up above right here at this 393, then that is a good area in order for us to, probably edge in and start looking for shorts or for puts, right? So that coupled also using your just regular technical analysis, like, you could see this volume divergence, right? So the volume fading down as we're getting this move up, and then we get another spike here on even lesser volume, right? So, you kind of got to put on your little detective hat here. So you get your second pop here where this volume is not the same as the first volume here, right? So this would have been a good one, maybe a risking high of day, or even right here on this last chance right here where this popped up again, right? This would have been a really great entry with even lower volume right here, risking somewhere up here towards the 390, 350, right? So what I'm saying is then then you're very confident in the trades because you're basically aligning yourself with the big market makers and the dealers on what their agenda is, right? And that's what we're doing is we're just going in here and trying to figure out what their agenda is. And if we know that they have to sell that premium in order for them to be able to make a profit, right? And get it underneath these levels. So this 392 first, and then the 390. Then we're going to go ahead and jump on the bandwagon with them, and we're going to ride that trend all the way down. And you could see what winded up coming of that, and where we closed at, right? So everyone that was up here that was buying these 395, 393 calls, they got bagged because the market makers moved that price back underneath here in order for those options to be able to expire worthless and make all that money. Now I got another kind of example, kind of a little bonus thing here that I want to show you. I have to put on the on demand. This is for Friday. So on Friday here, this is this previous Friday. I'm going to go ahead and speed this up here towards the middle of the day. Let's do like 12 o'clock. And we'll wait for this to work its magic and go in. There we go. So this is another thing here where I'm going to go ahead and pause this. So we can look at the option chain for that day, right? So this is on the 6th. And you could see if we're not able to get back below those prices, then the dealers have to offset their position, right? So I know this is getting a little bit deeper than what I wanted in the video, but if you're ever selling premium, that is a negative delta type position, right? So in order to offset that position, you have to buy either shares, equity, futures in order to offset that negative delta that they have, right? So you need to have those shares available or contracts available if you can't get the price back below that level that you want it to. So if we're looking here at this 385, we know that this is a huge level right here at with 28,000 contracts open interest, right? So ideally, what would happen is kind of like we saw today, is that we'd get this push over 386, and then it would fade back down underneath 385 and maybe close close to where we opened at, right? But that's not the case. And this is kind of a setup that's been happening quite a bit lately, is that if we get a really strong push in the morning and we're not able to break below the big open interest area here of the where the calls are stacked up at. So in this case, the 385, where those 28,000 contracts are stacked up at, then what do the market makers or the dealers have to do? They have to buy the shares, right? Or they have to buy futures in order to be able to offset their loss of holding these contracts, these 28,000 contracts. So what happens then is it starts pushing up the price higher because they're buying, right? You have organic buying of people that are just buying because they need to or want to, just trading, what have you. And then you also have the dealers or market makers that need to buy and offset the loss of those 385 contracts that they're holding. So we're going to go ahead and speed this up here a little bit more. We're going to put let's do, yeah, 111. We'll fast forward an hour or so. And I don't know why it didn't. Oh, I put it in the morning. That's funny. All right, so 1 second. All right, so then you can see right here, they did try a couple times right here for it to break this 385, right? So one, two, three, however many times right here, they tried to bring it back down to break this 385, but they couldn't. There's too much buying pressure in order for it to happen. And so then if we fast forward, and what happens is those dealers have to offset the loss, like I said, of those contracts, and they have to buy the shares or contracts, and then you get this really nice little kind of squeeze move to the upside at the end of the day, and you could catch some pretty nice moves on the SPX SPY, because the gamma is so sensitive, being 0 DTE. If you want to play it like that, or if you want to pay the next day's expiration, that would be a really nice move. But we're going to go ahead and speed this up here again, and you could kind of see where what winds up happening then in that type of environment. It pushes up here really hard here off of the 385 or so, a little bit above 385, and then we got 389, almost 390 by the end of the day. So this winds up being like 40 points on the SPX ES, or 4 points right here, just about. And we could go towards like the end of the day here. We'll put another, this will be like towards after hours, but it'll be able to show us the whole thing. And you can see that we did get almost to 390 then at that point. So in if you're trading options, it's kind of silly, and it just blows my mind that you're buying triangle breakouts, or you're buying head and shoulders, this and that, whatever. You got to treat this where you know where people are positioning themselves within the market. And so if you know that the big open interest right here and the big key level is this 385, and we're not breaking back below for the market makers to expire those contracts worthless, then they have to go ahead and buy those contracts again. They have to buy the contracts of the futures or equity in order to offset this loss right here. So the premium on there. So we could do the math for it, right? So whatever 28,000, excuse me, 28,000 contracts times 100, right? And they would have to buy that amount of shares in order to be able to offset it, and that makes the makes the price move pretty aggressively. And there's tons of examples like this. We could turn this off where there's tons of examples where there's key levels that get held and then they get pushed up here into the close. So like right here, the 380 was a really big spot if you remember a couple days back, and we held under the 380, and we needed to be able to push back above here because this is a puts environment right here, because the market makers that were selling the puts needed the price back above the 380, right? So in this instance, we got this really big run up here because we were below, and the market makers needed it up back above this 380 level. So it happens quite often, especially with the 0 DTE like we are talking about. It's been happening a lot more towards the end of the day, where the market makers need to make themselves whole in order to be able to in order to be good by the end of the day, as far as being net zero, right? So I wanted to share that with you guys. I hope that helps you out. I hope I didn't go too quick. I hope it all makes sense. Maybe if you need a more in-depth kind of video and me to dive a little bit deeper in it, let me know in the comments, and we'll go ahead and do that. We'll see you next video.